Hey guys, happy Friday. It is June 1st. I love the start of a new month. It's a clean slate. We're almost halfway through the year. I know you guys are tuning in because you want to know what is going on with this crazy interest rate market. So I'm going to be brief, get you guys up to speed. Most of you guys know who have followed me. What we're looking at on my screen right now is the bond market. The reason why is because fixed mortgage rates are directly tied to our bond market. And so I follow the bond market like a stockbroker follows stocks. That indicates what's going on with rates and where they're headed. So we know that when the price of a bond is high, interest rates are low and vice versa. And so just to give you some story, if we go back 2 years, 2 years ago, the bonds were trading at this 107 price point. So literally you could buy a bond for 107 bucks. That's when interest rates, literally fixed rates, were in like the 3.5% range and below. Then November 8th, which is when we got a new president, it doesn't necessarily matter that it's Donald Trump. Almost every year when we look at the data, when there's a new president put in office, the interest rates go a little wacky. But we can see here November 8th, the bond prices dropped really low, and that's when we started seeing interest rates in the 4% range, and we thought that the sky was falling because the thought of a 30-year fixed rate at 4% was just crazy. We hadn't heard that in years. And so what's been going on this year? Let's fast forward all this time, and let's look at just the last few months. In fact, let's look at the beginning of the year. So here, if you can see in the fine print, this shows you, I'm hovering over January 5th of this year. And look what happens. We see another big dip in the bond prices. And it lasted till about mid-February. And that's when interest rates got into the 4.3, 4.5% range. And people were freaking out. People who were pre-qualified a year ago, rates were in the 3s. Now they're in the 4.5s. Well, now look what happened. Rates mellowed out a little bit. And then boom, here on around April 13th, we saw another dip in the bond prices, mellowed out a little bit, and then look, this is May 17th, which was just a couple weeks ago. We are literally at the bottom of this chart. The bond prices were the lowest that we've seen in years. So what does that mean for interest rates? That means rates were the highest that we've seen ever, and they rebounded a little bit up here. You can see that, which was good news. But if I take this out a little bit, we see this rebound here, but then look what happened the very next day. It started coming right back down. And so for a split second, interest rates were a little bit better, but not much, because here at the bottom, they were trading at 100.94. So 100.94, here they were at 102. So it's just a 2 difference, not a drastic change in the interest rates. And so the question is what is going on? What caused all of that? Well, if you guys have been following on a little bit with the news, there's a lot of talk about Italy. There's lots of talks about the tariffs. And so that's why interest rates are kind of going up and down. 86% of economists are projecting that rates are going to get to 5.5% by the end of the year. But where are rates today? Well, you guys know that attached to this screen, I always include what Fannie and Freddie are lending at today. So what that means is Fannie and Freddie are lending to the banks at a 4.56% interest rate. This is coming directly from Sam, the chief economist at Freddie Mac. So Fannie and Freddie, they lend the money to the banks, and what do you think the banks do? They're not going to lend you at the same rate that they're paying. So this gives us a baseline of where rates are starting at, because it doesn't matter if you put 40% down and you have perfect credit, they're not going to lend to you at this rate. Now you'll be a little bit higher if you're a perfect scenario, but you're going to be higher than a 4.56, especially because this fine print says 20% down. So to give you an idea, if you pull up Wells Fargo's rates, Wells Fargo is advertising a 4.625 this morning, and if you read the fine print on this, it says 25% down, a 740 or above credit score. I also pulled the online rates this morning showing our friends over here at Quicken Loans. They're advertising 4.875, 5.125, 4.75. So again, what causes these rates to fluctuate? And these are advertised rates. So let me back up and say, do you think that they're advertising best case scenario or worst case scenario? They're advertising best case scenario. That's what marketers and advertisers do. So if you are putting 25% down and have a 740 or above credit score, you're probably looking in this ballpark right here. If not, you're probably going to be a little bit higher than this, or your closing costs are going to be a little bit higher because you're going to have to buy discount points. So a lot of people are in shock right now because they haven't been following along with the bond market, and they're like, oh my gosh, I mean, you quote somebody a 5.125 interest rate and they about have a heart attack. And I get it. We haven't seen this in literally years, since 2006. So you have every right to be feeling, especially if you just went under contract, you know, you have every right to be feeling the way that you do. But it's important that you know the data and you know the numbers, and you don't just think, oh, well, that interest rate seems high. You have to have facts and knowledge behind it. So thank you for tuning in. As you guys know, I bring an interest rate update every single week. We love being transparent. Check out my video vault for even more videos. If you have any questions, comments, you know how to get a hold of me on my homepage. You can call, email, text. Otherwise, you guys have a great weekend. Take care.